Hi, everybody. This is Josh Jalinski, the financial quarterback, with my father's all-time one of my favorite all-time guests, Professor Kotikoff, back by popular demand. Now he is a TikTok celebrity, along with 18-year-old girls and people who dance. Now we have people who educate the next generation on finance. So Dr. Larry Kotlikoff of Boston University fame, who just was featured in some big article telling retirees how to spend their money and just leave it a lot in cash, which I got to get that article. That was a fun article I want to read.
Yeah.
What was that article? Do you know what I'm talking about? You got some national press on something.
I think Barron's did a profile, and then there was some a lot of comments. Some people were negative because I talked about pulling out of the stock market before it crashed last March, and so then there was I responded to the comments. So I was like on Barron's homepage twice for like 2 days.
Well, you know what? I salute you, Larry. You know why? So many people are retired, and they did sell off in COVID. And a lot of professional money managers sold off, and they didn't tell anybody. A lot of people in the know sold off because it was a scary time to be an investor. And I think what it underscores is when you're nearing retirement, you should have a certain amount of money not tethered to the market, because we could have COVID. We could have some other bio weapon years from now. We could have COVID, Mu or Lambda or, COVID Z. Talk about that, because I really appreciated your honesty, and I sort of agreed with you slamming the average retirement planner. I'm sure, the people who were trolling you with negative comments were probably financial advisors who were unsuccessful, who had nothing better to do than troll you on the article. But I liked it. You were honest. What do you think about that?
I mean, first of all, they didn't have an opportunity to hear what I really was trying to say in full, because I was just, in this profile, there were some questions. I gave a longer answer, and the reporter didn't have the space to fully convey. So I don't know whether we really had. So here's what I was trying to convey. That unfortunately didn't get into the profile, which is that economics tells us, finance tells us that we shouldn't try and time the market for return. That we can't guess, or we can't kind of predict where the market's going to go. The market's basically a random walk, and where it's going to go depends on new information that comes in, because existing information has already been processed by the market. If it's efficient, we have a very highly efficient financial system. So only things that people don't know, which is new news, are going to come in and change the market return, and that's not predictable. So that's why we economists think that you cannot time the market for return. On the other hand, you should time the market for risk. Finance also tells us that. So when things get riskier, when the economic environment gets riskier, and it certainly was riskier at the beginning of COVID, it's still riskier, I think, given that we're not out from under COVID. But when you start seeing the economy shut down, you've never seen that happen. You don't really know how many people are going to be able to work remotely. Well, the market's much riskier. The VIX, the index of risk, is going up. So personally, I said, well, I'm going to do what economics says to do, which is to reduce my holdings. And sure enough, the market dropped 34%. Other people pulled out. And then something that I didn't really predict happened, which is that the Fed came in and started buying up corporate bonds like crazy to support, in effect, the stock market.
Had that ever been done before, right? That was never been done. That had never been done before, correct?
Well, I think you could argue that they did this in 2008 in the Great Recession, a little bit, late in the day.
But that was the Fed buying treasuries. They weren't actually buying corporate bond ETFs like LQD and iShares and Vanguard. I mean, I thought that was uncharted territory. Right?
I think there's probably been, I think you know more, Josh, about the details of what they've been buying, but I do know that in the Great Recession they were buying some pretty, they were buying, they were basically jumping in as the bank of the country,
Yeah.
and making loans to all kinds of entities, and which I think, we had a financial panic, and the market still dropped 53% between 2008 and the kind of the middle of 2009. It was down 53%. So even with the Fed coming in, there's no guarantee the market is going to go back up or right away. So it's a riskier situation. I pulled out. So that was the smart thing to do. And I think that you're right. As people get older, they can't. There's nothing. Most people think that the stock market is safe in the long run, and there's this entire bucketing strategy that the conventional financial planners tell their clients that, look, we're going to put this much money into stocks, and we're going to take it out 20, 30 years from now, because over the long term run, we can trust that it will be there with a decent return. Well, economics doesn't tell us this. Finance tells us the opposite. When you have a random walk, things get riskier with time, not safer. And if you look at the actual cost of buying insurance against the stock market going down below a certain value, kind of buying a put on the market, it gets more expensive the further out you go. So the stock market is riskier, not safer in the long run. So we can't count on it. We just have to know that it's like going to the casino, but it's a casino that's not geared against you, where the dice are loaded against you. It's a casino with a great return on average, but a lot of volatility. And when you put more into the market, your upside on average is going to be much higher, and your downside and the chance of your making losses will go down, but the magnitude of those losses will get bigger. That's the important thing to understand, that the magnitude, you'll have fewer cases of losses, but when they're bad, they're much worse. So we don't want to be living on cat food, obviously, in old age. So we, putting in a reasonable amount in the stock market, but timing it for risk, these are sensible things to do.
Yeah, I don't really understand the brouhaha over the article. There apparently were 200 plus comments like the first day on the article, which signals to me that financial advisors were on there who had nothing better to do to negative. But I think you bring up so many good points because of the honesty. And I think it underscores the need for retirees to think about risk, volatility, and what you are, personally, everyone has to build a portfolio. I always say this, that you won't vomit out when the market goes down. And it could mean only 25% in the market, or 30 or 20 or 40. And you never hear that. And that was why it was kind of cool that you were saying that. You also never hear when a finance guru gets it wrong, because they are rarely honest about that, because they want people to believe they are the guru or the shaman on the mountain. And I love that you were honest. So I commend you for the article. I think it was, I didn't even know about this comment thing until you told me about it. And I think most people, I never read the comments because it's always trolling or something. And
they usually, they're usually negative. Comments are usually negative.
So if I'm featured, I never read a negative comment. But just because it's then you're fighting the people. Although, hey, it probably got more publicity, and they probably will want you to write a follow-up on it. But I would agree that most retirement planning is wrong because they don't follow the teachings of economics. They follow math. And money is not math, and math isn't money. I want to get your take on that topic. But first, we got to take our first break of the hour. with Larry Kotlikoff, guy who grew up in Jersey, Camden, New Jersey, and made a name for himself as one of the top professors of economics in the world. So, folks, if you have a question for him, go to youtube.com, search for Josh Jalinski, the financial quarterback, and write it in the chat box. We'll be back in a moment. And we're back. Give us a call, 888-988-JOSH. If you want the 45-minute ultimate financial game plan for retirement, or one of Professor Kotlikoff's, we'll also throw in his Maxify Planner if you want that, or his MaximizeMySocialSecurity.com review. So, Larry, what do you think about that? I was taught by a mentor in the industry. This is when I was 23. Money is not math, and math isn't money. Comment on that. I love that quote.
Well, yeah, I mean, that's a good way of putting it. I mean, we're focused ultimately on our consumption, and we're worried about we really are interested in having a smooth ride with respect to our living standards. So we're not just interested in finding some way to accumulate the most amount of money so that we can die with the biggest, unspent bundle of cash, so deprive ourselves our entire life. So we have to, focus on the bottom line, which is not money per se, but it's consumption. And we want to make sure our living standard, our consumption is steady and is able to withstand shocks, that our living standard, if the market drops, we want to make sure we're diversified so we don't have everything in the market and lose our shirt and then maybe panic, or not panic and just say, this is too much for me, I've got to get out, get to some safety, and then I've got a lower living standard the rest of my life, especially for somebody who's retired, who's not able to recoup by working longer. So economics definitely, we use them, it's a highly mathematical subject. Every paper I write has mathematical equations out the wazoo, but they're about people's concerns about risk and sustaining their living standard, and how they can optimally, deal with the risk, and also make smart moves that don't involve risk whatsoever in terms of raising their living standard. Like, you and I have talked a lot about Social Security over the years. There's downsizing your home. There's Roth conversions. There's issues of moving to states without taxes. There's working longer. There's all these, in terms of retirement, there's all these safe ways, or relatively safe ways of raising your living standard that don't involve investment issues, and people aren't really taking advantage of those. So that's one of the things I've been trying to convey. I wrote I don't know if we talked about this yet, certainly not online, but I have a book coming out called Money Magic in January. It's coming out January 4th. And if people can see, I'll just show you the cover. It's a really cool cover.
I'm excited about
it. It's got rabbits coming out of a hat. Now the rabbits are origami rabbits, and the paper that they're made out of is dollar bills.
We'll so show really the title. Cool, show it again though, because you faded out because you're in a lab.
So money. Yeah, can you see that?
Oh, there we go. An economist's secret. So I want to know what these. So one of these are, and this is critical, folks. Money is not math, and math isn't money. Yes, I mean there are formulas and stuff, but what I mean is the general. I loved the Barron's article because I would argue the general formula applied by most financial planning today. And now I don't want to tick off financial planners watching, listening on the iHeartRadio app. If you miss a part of the episode, go back to iHeartRadio app, go to our Spotify app. Most people use this formula. I'm not the professor, so I'm sure you have a better formula. Money equals rate of return, the risk you're willing to take, times the amount of money you're going to put, wealth you're putting in, times time. Basically, 99% of financial planning uses that basic formula, which to me is inherently flawed. There's no inflation. There's no taxation. There's no risk. Then there's like the risk you're willing to take. But then what happens when your actual, I don't know if you would call it the risk quotient or risk acceptability. Like when you see your actual, like you said, if you have a larger account, let's say you're worth $2 million and you had Coke stock, Disney stock in March of 2020, and you see it go down and your 2 million is 1.2. How would you feel? Like you came from nothing and you lost 800 grand in a month. That you could probably make it a formula, but that's what I mean when I say money is not math and math isn't money. That money erodes over time. There are wealth eroding factors. There's all these things that people are just oblivious of from their average. I really like the article. I thought it was a good article, Larry.
Cool.
We had Barry Dyke, I don't know if you heard of Barry Dyke. He wrote the book Pirates of Manhattan.
I think I've heard of him, yeah.
He loved the article. This guy sold 30,000 copies of a self-published book, and he kind of went in and exposed like what banks were doing with their money in 06 and 07, kind of leading up to the crash. It was very interesting. And we used this article because it came out right before my interview with him. I was like, this is a really good article. And he agreed and I agreed. I think the traditional, what I would call Wall Street industrial complex of funds and stockbrokers and funds, they want you to have all your money in the market. But I think a lot of people would benefit from an annuity or from, things that are more conservative, not for all your money. Of course, stocks are better for the long haul, but you have to understand like what you're willing to take on with risk. And also what you talk about consumption with your Maxify planner. Another word for consumption is enjoyment. You don't want to be not enjoying the last 10 to 20 years of your life on earth, and then you die, and then some ungrateful kid gets all the money and pisses it away, right? So let's talk about money magic. What are some money magic moves that our listeners can make now? I know we've talked about this before, but I always think they're good tips, since you're usually the Social Security guru.
The book's like 300 pages, and it's really geared for everybody. There's discussion of career choice for younger people, and whether you should, one chapter is called "Don't Borrow for College." There's a chapter about marrying for money. There's a chapter about how to get divorced like an economist, and then invest like an economist. And what does that mean? How do we think about investing as opposed to conventional planners? So and then Social Security and dealing with retirement accounts. But in terms of some magical trick. I mean, right now, if I was thinking about investing, I would say the best investment is to pay off if you have any student loans with high, those interest rates are high, even though they're have been issued by the federal government, they're typically around 5.
But what if Liz Warren becomes the president and forgives all college debt?
Yeah, I don't see that happening. It could happen, but I just think that's so unlikely.
Who's your presidential prediction for 2024?
Oh, Trump against Biden. I think Biden will win. I think Biden will.
It's going to be Biden, Trump again. I think it's going to be DeSantis versus someone else. I think Biden steps down and we have somebody else, but that'll be interesting. We'll be right. So you're calling for a Biden-Trump rematch?
Well, I think that's probably the most likely, but not very high probability. I mean, it's probably 60% probability that's what we'll have. And I think Biden actually is doing a good job on balance. I don't think he's made any huge mistakes. We could discuss what happened in Afghanistan whether that could have been done better. I'm sure it could have been, but he bit the bullet and got us out of there, which we should have gotten out of there 15 run in.
I don't want to go there. The withholding of Regeneron. I had COVID, right? Regeneron saved my life, and they're withholding. But anyway, I don't want to get political here. But the withholding of Regeneron, I think, is one of the greatest misreported crises of the last year. But
they're withholding it now.
Well, they said they were going to ration it out of the red states because there was less vaccinated, or Then they got some bad press for it, so they retooled it and said basically they're distributing it.
Well,
but anyway, I think we'll probably. Oh, go ahead. Sorry.
Well, anyway, so in terms of money magic tricks, there's clearly being patient with Social Security. For most people, we should have about 75-80% of workers waiting till 70 to take Social Security. Only about 6% at most are doing that. There's a huge gain to be had there. Most people are taking their Social Security before they take their retirement money. It should be exactly reversed. People need to know about the 13 different Social Security benefits that are out there, because a lot of people don't know to ask for benefits that are owed to them, and then they don't get them. We have to think about, Roth conversions from your, if you want to take your retirement account, your IRA, and traditional one that's taxable, pay taxes on the money, put the money into a Roth because you're worried about future tax increases. That might be a smart move, but it might also kick up your Social Security benefit taxation. It may also kick up your Medicare Part B premiums 2 years later if you're going to be, because those premiums are connected to your modified adjusted gross income 2 years before. As crazy as that is.
And that's in your Maxify planner, correct?
Yeah, all this stuff is in the software. And what I did was I've spent years developing the software, and all the lessons I've learned from running the software I put into this book, because I know, a lot of people like to run the software, but a lot of people just like to know what to do, and don't have necessarily the patience or interest in running software. So I try to, provide enough cases that people would see exactly what position they're in, and then know what to do on any particular issue. There's a whole chapter here about college and whether it pays to borrow money to go to college, and how to work around, how to actually get to college without borrowing money.
Well, we'll talk about that when we return with world-renowned economist Larry Kotlikoff. You can go to maxifyplanner.com if you want to sign up on your own. It's a very powerful way to plan, not just for saving money, but also income. Income is sort of the outcome, and it doesn't use outdated rules of thumb. You can go to maxifyplanner.com, or you can call us at 888-988-JOSH, and we'll throw in a Maxify Planner report customized to you and your family for free when you schedule and keep your no-obligation 45-minute ultimate game plan for retirement. 888-988-JOSH. And go over to Amazon.com, buy any of Larry's books, or you get one book free by Professor Kotikoff, whether it's on Social Security or whatever book you want. Call us 888-988-JOSH now, 888-988-5674. We'll be back after these messages.
The preceding program was sponsored by the Jalinski Advisory Group.
Any awards, rankings, or recognition by unaffiliated third parties or publications, including 5-Star Wealth Manager, Advisory of the Year finalist by Senior Market Advisor, and top of the $1 Million Roundtable, are in no way indicative of the advisor's future performance or any individual client's investment success. No award, ranking, or recognition should be construed as a current or past endorsement of Josh Jalinski or Wealth Quarterback LLC. Information regarding specific awards, rankings, or recognitions is available on the Wealth Quarterback website at www.jalinski.com. joshjalinski.org. All investment strategies have the potential for profit or loss. Investment strategies such as asset allocation, diversification, or rebalancing do not assure or guarantee better performance and cannot eliminate the risk of investment losses. There are no guarantees that a portfolio employing these or any other strategy will outperform a portfolio that does not engage in such strategies. This broadcast should not be construed by any client or prospective client as a solicitation to effect or attempt to effect transactions in securities or the rendering of personalized investment advice. Due to various factors, including changing market conditions, the information discussed in this broadcast may no longer be reflective of current positions or recommendations. While information presented is believed to be factual and up to date, Josh Jalinski and Wealth Quarterback do not guarantee its accuracy, and it should not be regarded as a complete analysis of the subjects discussed. The tax and estate planning information discussed is general in nature, is provided for informational purposes only, and should not be construed as legal or tax advice. Listeners should consult an attorney or tax professional regarding their specific legal or tax situation.
Advisory services offered through Wealth Quarterback LLC.